So as an investor today, I've heard you describe yourself. What is a process purist?
I acknowledge that outcomes have a lot of weight and matter, but for me, the process behind those outcomes really matters. It's not just about results, but the quality of the decisions behind those results.
So all of our investment professionals travel a lot, and you want to kick the tires.
It brings a cross-asset perspective that I think leads to a more comprehensive analysis and deepens the understanding of opportunities, a really great way of fostering intellectual honesty and debate that can help us get to better collective outcomes.
Today, we have a very special guest, Andrea Montero. Andrea is a fixed income investment professional. She's based in New York City. She's been at Capital Group for 8 years. Welcome, Andrea.
Thanks, Mike. Excited to be here.
Coming all the way from New York City to the LA studio to do this. We appreciate it. So I'm going to start us way back, about 25 years ago. And 25 years ago, you and your family emigrated from Colombia.
Yeah.
Talk a little bit about that transition. I'm sure that was a good foundation, and talk a little bit as well on how that got you into finance early on.
Sure. So as you mentioned, I was in my early teens, not to date myself here, but we emigrated from Colombia because we were essentially seeking the kind of stability and security that wasn't available to us back then at home. And we came here with very modest means, and I watched my parents really struggle to make ends meet. And what that meant is that I realized that their leap in coming to this country was really setting me up to make the most of an opportunity that they had, afforded me and sacrificed for. And so as a result of that, my path really became a function of seizing opportunities that were available to me rather than really just seeking what it was that I wanted to do. But fortuitously, when I went to high school in Florida, the high school basically made available this finance program where we had a finance-focused curriculum and hands-on learnings. And as a result of my involvement in this finance program, I got a college scholarship. But the caveat was that I needed to pursue finance as a degree. And that was fine with me. I really enjoyed it. And again, this was an opportunity that presented itself that I wanted to seize. And as a result of that, I went to school, had a bachelor's and a master's in finance, and kind of the rest is history.
You joined us as a summer associate.
Yeah.
After business school. Why'd you come back? Obviously, you had an offer, or
Yes.
you wouldn't have. But
Right.
why'd you end up coming back? What was your decision? Because you had lots of things you could have done at that time.
Yeah, I mean, the list is endless for why I decided to join Capital. But I think the two salient points for me was one, the autonomy of the role, and two, the culture. And related to the autonomy, the experience felt uniquely entrepreneurial for a job in finance. And the reason why is because, it was a 12-week internship where you came in, you got assigned a sector, you got to look into a couple of companies, but it really was up to you what to make of that process, how to go about learning, how to go about, interviewing management teams. But you were provided this wealth of resources to do that with. And I really appreciated having that blank canvas to think critically and pursue what I thought mattered most. And I thought that really placed a strong level of trust on us as analysts. And that was very appealing to me.
So as an investor today, I've heard you describe yourself, because we do these meetings with all of the other investment professionals where you share your process. You call yourself a process purist.
Self-proclaimed,
So
yes.
what is a process purist?
For me, I acknowledge that outcomes have a lot of weight and matter, but for me, the process behind those outcomes really matters. So it's not just about results, but the quality of the decisions behind those results. And so, if I could simplify it, if you gave me two identical choices, I'm not indifferent between them. I would always try to spend the extra time to identify which one was the result of, a better, stronger process. And that matters to me a lot.
So would you say you're more of a scientist than an artist in that way?
I think you allude to the fact that investing is both an art and a science. And so I try to lean on the science piece of it a lot just because of my style. But, being a cyclical investor, and we'll talk about this later, covering energy, you have to learn to be flexible. And so while I have my tilt, you have to employ both.
So with that process in mind and having some science be the driver and then wrapping it with some art, how do you know when a certain risk is worth taking? Obviously, it's different with every single investment conviction and idea you have. But how do you get a sense, this is a relatively big risk, especially with the sector you're in oil and gas.
Yeah.
But how do you get that sense?
So I try to assess risks in 4 dimensions to contextualize them. And those are, for me, 1, level of conviction, 2 is the margin of safety, 3 is the time horizon, and 4 is the asymmetry of outcomes. And so as it relates to conviction, that really is about how well do you fundamentally understand this risk. And the higher the conviction, usually the more comfortable you get taking the risk.
And is that a score? Do you have a scoring system on that, or is it's just a mental checklist?
Yeah, it's a mental checklist.
Got it. Okay.
And then, when you think about margin of safety, that's related to valuations. The higher the margin of safety you have, the more room for error. So the more prone you are to take a risk. And so you could think about pairing a lower conviction idea with a higher margin of safety investment, and that makes a risk worth taking. The third piece being time horizon. So, does the risk change the investment thesis if applied over a short time frame or longer time frame? And you often find that, if you have a longer time frame, you can make the risk more palatable and more prone to take it. And then finally, the asymmetry of outcomes kind of speaks for itself. The more positive the asymmetry of outcomes, the more likely you're to take it.
And can you give us an example of some time where you really had to push yourself? A risk didn't necessarily come naturally, but you said, you know what, I'm going to move outside my traditional comfort zone and just do it, and how it played out?
Sure. So I can think of an example during the COVID time period. It was early March, and we had seen COVID spread to Europe, and U.S. borders were closing. And it was the Sunday after the U.S. borders were closing. I remember it so clearly, March 8, 2020. And we were getting indications that the Organization of Petroleum Exporting Countries, which is the kind of oil group that supports the market, was not really looking to support the market at the time because the shock was so intense. And I remember writing this note called brace for impact. Oil prices are about to take a nosedive, and man, did that really foresee what was about to happen. But I say this because it was a Sunday morning when kind of this all came together for me. And Monday morning, you come to the office and the market's open, and oil is falling from, it wasn't the low 40s to low 30s, so a 10% fall. Prices were opening anywhere between 15 to 30% lower for some of the energy holdings we had. And the hardest thing was to decide to sell at that time. It doesn't come naturally for me to sell what seems like a losing investment at the time. You want to apply that long-term time frame and try to hold through volatility. But because I had some sense that my thesis was broken of where the oil prices were eventually going to be, it just made sense to sell. And so I really had to push myself to make that decision and basically lower a risk exposure in energy in portfolios at that time.
Well, that was a super interesting period of time. And anyone who says they were prepared for that time is a liar. Because
that's right.
Because no one was alive 100 years prior when we had our previous global pandemic. So with the closing of the global financial markets, and it effectively, no one really knew how it would play out. And that's going to lead me a little bit to our office treasure hunt, because at that period of time, you probably thought you needed to put this on, which I found in your office. So I will ask you to describe this for our listeners. We have some viewers who are able to see this wonderful hard hat, but I'm going to hand it to you and ask you to describe what it is and why it's in your office.
Sure. So I won't attempt to put this on, but this is a hard hat that I got from one of my research visits to an oil sands mine in Canada. And for those less familiar with the oil sector, Canada has some of the largest reserves of oil in the world, and over half of their oil comes from the oil sands. And the oil sands, as the name implies, is basically this mixture of clay, sand, water, and very heavy oil called bitumen. So you can think of like tar or asphalt with like a really thick viscosity like molasses or honey. And so a lot of the oil sands tend to be very close to the ground, such that they can be extracted via wells. And the companies will basically create these big open mine pits where they'll extract this ore and then transport it to a processing facility to basically then take the oil out of the mix. And you work this on the mines, and it's really impressive operations. And we went on this research trip with the goal of really understanding how a company could continue to drive costs lower for what's a really complex operation. So this was a little souvenir from that trip.
So I'll take it from you. So they gave this to you, and then I'm going to do a 2-for-1, Andrea, because there's another picture that I think is one of the coolest pictures going. So you are an oil and gas analyst, and the picture, I'll describe it. I'll give you a break from describing things for the folks who are listening. It's Andrea who, what are you, about like 5'7"? How tall are you?
5'5".
Oh, geez, I gave you 2 inches. Five. So you're 5'5", and it is you, and you're about a third of the way up a wheel of machine that looks like it's about 30 feet tall. I don't know how tall these machines are. So tell us what you're standing in front of.
So this is a dump truck, but not an ordinary one, because as you mentioned, it is massive in size. I'm standing next to what is a 12-foot tire, and the height of this thing is about a 2-story household. So it's pretty high, and you need a ladder, which you can see over here, to go up to the cab because it is so high. And these trucks are in the mines, basically transporting the ore to the processing facilities. They can carry anywhere between 300 to 400 tons, which is somewhat the equivalent of, I want to say, 250 passenger cars in weight, and can carry the equivalent of 180 barrels of oil. And the trucks, are really cool in that some of them are autonomous and they run 24/7, but they are massive in size. And you can see how tiny I am in this picture relative to...
Was that your first time seeing one of these in person?
This was my first time going to an oil sands mine. And, you really respect the operations behind the investments that we make by doing this on-the-ground research, because you realize just what it takes, for example, in this case, to produce the oil.
That's interesting. That's autonomous, and it can carry that kind of volume.
That's right.
And just running 24/7.
Yeah.
So let's get into energy.
Okay.
What when you're thinking of different themes in the energy space, what's taken up your mind space today?
Sure. So I think there's 2 key structural themes that I'm thinking about and 2 cyclical ones. On the structural side, I really wrestle with this thing that we call the energy trilemma, which is the trade-offs between energy security, energy affordability, and energy sustainability. And understanding which regions prioritize which pillars and when is a really important way for me to assess the long-term opportunities and risks in the energy space. The other structural theme that, is taking up my mind is the interplay between technology and geology. You can think about geology as where the resource is. It's finite, it's depleting, and it's fixed. And technology is how and whether we can extract that resource. Technology evolves. And so can we do it safely? Can we do it economically? And there's an interplay between those 2 factors, and understanding the relationship between them helps you better assess kind of the response mechanism and the adaptation that the industry has as on the passage of time as markets change. Now, the 2 cyclical themes taking up mind space for me, one has to do with OPEC policy. Yes, I mentioned OPEC is the cartel of exporting countries primarily in the Middle East and Africa. And for the last 2 years, they've been supporting the oil markets by withholding supply. But now they're starting to release volumes back to the market, and that creates risks of potentially oversupplying the oil markets and driving prices lower. So something that's keeping me busy these days. And then finally, geopolitics. It's the ultimate wild card. It's unpredictable, but has a really important, I think, influence in where oil and gas prices can go. And as you know, there's a lot of kind of fires concurrently going, whether it's Russia, Ukraine, Middle East tensions, the U.S. trade relationships with China. So I would describe kind of those as the structural and cyclical themes that are occupying my mind.
And looking at oil and gas, how much do you have to be sort of have this crystal ball in the future of actual prices of oil? Because that, you talked about OPEC, you talked about how they limit supply, how they increase supply. Do you have to have a fundamental view on where oil will be 3 to 5 years from now for your thesis? Or is that just one of 20 different things that go through your mind when you're thinking about it?
It's a top 3, and it's very important. The challenge with that is that it's hard to get it right. And
it is.
It seldom goes in a straight line, and things happen. And so I think part of the core principles with which I invest is to think probabilistically. And sometimes, the range of outcomes seem more narrow. Times like today, where there's higher uncertainty on policy, more geopolitical tensions, the path of outcomes increases. That for me means require a higher margin of safety. And so it's based on these principles and thinking probabilistically that I think you can kind of wrap your head around, possible outcomes for what is a very, very, very difficult variable to call.
Yeah. So all of our investment professionals, you included, travel a lot.
Yeah.
and you want to kick the tires. Now that's a very big tire. We showed a
The
picture.
little tire,
You don't want to
yes.
kick that tire, but you want to kick the proverbial tire. You want to go and see something. You want to see how it's evolving over time. So you come back from one of these trips, and it's either confirming your thesis or it's giving you a new idea, or basically telling you something that you're in might not be so great. So talk to us about when you come back. You've been gone on the road for a week. You're exhausted. You come back with all of these ideas on a notepad, and you want to share it with your colleagues. Talk about the collaboration with fixed income colleagues and equity colleagues when you return from one of those trips. And effectively, you're doing a readout of your ideas.
Right.
How does that work in real life?
Yeah. So maybe for context, a lot of these trips, it's not just me, it's a group of us. And oftentimes, as you mentioned, we'll represent both equity and the fixed income side of the business in these trips, and we'll travel together. And also oftentimes the portfolio managers will come to these trips, since so many of them used to be analysts and really enjoyed the opportunity to go on research trips. So once you come back, the first thing you do is you kind of put your thoughts together, and we tend to put research reports that will then bring to investment calls. And what's great about investment calls is that you'll present your insights, and many times either the portfolio managers or the other analysts that attended that trip with you will also present their views. And what you have is a very well-rounded conversation about takeaways and investment perspectives. What's interesting is that not always do your views align. Maybe a portfolio manager that attended with you on one of these research trips has a different opinion, disagrees with your assumptions. But what that leads to is really, again, well-rounded discussions where we can challenge one another, like really probe how we're thinking about themes, and ultimately informs everyone what to do with their portfolios. Even if a portfolio manager, on these investment calls disagrees with you as the analyst, it doesn't prevent me from going and investing in my idea, but it does present it to a broader group, for debate. And so I think what this does is both the traveling with equity colleagues and doing these trips and meeting management teams, it brings a cross-asset perspective that I think leads to a more comprehensive analysis and deepens the understanding of risks and opportunities. And I just think these investment calls are like a really great way of fostering intellectual honesty and debate that can help us get to better collective outcomes.
So you mentioned that as an analyst, and all of our analysts are investment professionals, they invest client assets. So even if a portfolio manager doesn't want to do what you want them to do, you do it yourself.
That's right.
Now, you also recently have taken on broader portfolio management responsibilities. So you're still an analyst, but because you're not busy enough, we ask you to do a lot of other things as well. So we've asked you to take on some broader portfolio management responsibilities. Where do you see opportunities as an active manager to beat a passive benchmark? How do you think of that now that you're taking on this new remit?
Sure. So maybe thinking about the context of today, since tariffs were first announced, the market has had an incredible rally. But what's interesting about the kind of cross currents happening today is that all-in yields are decade highs just because the Fed was hiking rates so much back in 2022. And you find that, the excess compensation that you get on top of the risk-free rate, so what we call credit spreads, are in the very low percentile looking back 20 years, but yields are at the top 100th percentile.
So you're adding 4 or 5% risk-free rate or treasury yields. You're taking on a 75 to 100 basis point credit spread, and your all-in yield is super high and attractive for income.
Exactly. And so you're starting from a really attractive valuation level. However, because that risk piece of it that makes up the overall yield is so compressed in an environment where we're seeing the economic growth soften, there's a lot of uncertainty. I think about taking a more cautious stance because there's downside to these risks, but your valuations are not giving you a lot of margin for safety. And so I think it's a great time for an active manager to add value by upgrading the portfolio without giving up a ton of compensation. So you can still be investing in really attractive, all-in yields or having a good income target by still being defensive. And if you add on top of that, idiosyncratic ideas that populate the portfolios from, the analysts on different groups, you can add significant returns from that idiosyncratic process. And so right now, I think there's a lot of opportunities in higher quality sectors like agency mortgages, AAA or senior tranches of structured credit, and even the corporate space. So again, a lot about you can upgrade your portfolio, build a more defensive stance with that capital preservation lens in mind without having to give up too much income, just given how narrow that risk premium is these days.
So that would mean that the average credit quality in your broad portfolio, let's say it had been something like triple B plus or single A minus, it's going up in quality. You might get a little less income, but you feel more secure in having a higher credit quality security in your...
That's right. And that relationship between higher and lower quality is so compressed that, again, what you need to give up to increase that resilience of the portfolio is not that much.
And a lot of the drivers for active management over passive in the bond market, duration, curve, credit, do you find that you rely on credit a lot because you're a credit analyst, or do you, now that you're a diversified manager, do you lean on duration and curve just as much? How have you found that in your process?
Yeah, as you allude, like naturally, I gravitate towards where my background is, which is doing corporate credit and research. But I really try to lean against relying on any one lever too much. I think there's a really great set of opportunities, whether it's in structured credit or, as you mentioned, in the rates market. And well, that remains my primary lever for populating the portfolio with ideas. I try to not be too overly reliant because I am trying to seek consistent set of results, and I think diversification plays an important role in that.
So, just for folks who are listening and watching, when you go from an analyst to a portfolio manager, what's the biggest difference? Is it the number of securities you're looking at, the breadth, the macro, the complexity, the portfolio construction? Like, it's just how different is it to you from being an investor who's an analyst to an investor who's a portfolio manager?
Yeah, the differences are, many of the ones that you mentioned. I think the concept of depth versus breadth is like very important in that, as an analyst, you're spending so much time on a narrow set of opportunities and you dive deep and you're living in the weeds and the details. And this is how you come up with the ideas. As a portfolio manager, you kind of become, as the saying goes, a jack of all trades, master of none. And you spend a lot of time in portfolio construction and you kind of rely on the analyst to give you a set of ideas for security selection. And so that depth versus breadth, dynamic certainly is one of the differences. The other piece is being a more concentrated versus a more diversified investor. As an analyst, again, because your opportunity set to invest is more narrow, you will generally be significantly more concentrated. And that's kind of what you want to do.
High conviction, concentration.
High conviction, concentrated, being bold. And as a portfolio manager, as we were talking before, you try, at least I do, to not have one lever really drive my results too much. And I have a lot more levers to pull from. So I think a lot about that diversification component when it comes to risk management. And then I think the last piece I would say is, as an analyst, you're an idea generator and you spend a lot of the times doing the trips that we talked about, looking into the details of companies and coming up with best ideas. But as a portfolio manager, you're more of an idea translator. So you're trying to gauge what the analysts are saying. You're trying to calibrate their ideas and ultimately how they all fit together in the context of portfolio construction. So it's, you're both investors, but the lens with which you're approaching investment is so different.
Yeah, that makes sense. So talking about that and your portfolio management responsibilities, what's your specific investment edge? What's that one thing that you do consistently that generates differentiated outcomes for clients?
Sure. So this may not come as a surprise given our prior discussion, but for me, it's being a process-oriented, principles-based investor. And, that doesn't really mean just having hard rules and, there's one single answer for all things. But it does mean having something to anchor to, because when there's a lot of volatility and markets are rapidly changing, you need to make decisions with imperfect information in short periods of time, under pressure. And I find that in those times, having something to anchor to is a really important way to keeping me focused. And so, principles that I stand by are, thinking probabilistically. We talked about that. And the greater range of outcomes you have at hand, the more margin of safety you should require. The other point is just keeping it simple. I like to not overcomplicate things, and I like to distill it to key drivers. And I find that the less inputs that a thesis requires, the higher your odds of success. And then I also think about, things like liquidity. It's so valuable, and you always want to be managing to that. So these are a core set of principles, not necessarily answers that I like to live by. And, it fits my style being process oriented, because I am much more the type of investor that is pursuing kind of small but consistent wins over time, rather than, like the really one big great idea that does really well. And so for me, this principle-based, process-oriented approach works well with my style and how I think about generating consistent returns.
Yeah, and that makes sense. And there's so many different styles for different investment professionals. That's why putting them together as portfolios helps so much. This will be the safe zone humbling moment of lessons learned. And every time I say this, people tell me the 100 of mistakes they've made. But where was something, and especially with what you've covered in oil and gas, it's so volatile.
Yes.
But where are some places along your journey? What are some mistakes you've made that you've learned from?
Sure. So, in 2019, there was this great credit story of a company that had made an acquisition. It had levered the balance sheet as a result of it, but it was a better company as a whole. The assets were better because of this acquisition, and they set out a very clear path for deleveraging, asset sales, and using the free cash flow to pay down the debt. I mean, you couldn't have like a more perfect credit story. And so we invested into this story, kind of going into 2019, and of course, everyone has a plan, as they say, until they get punched in the face, a Mike Tyson quote that I'm borrowing here. But COVID comes along, and what was a beautiful deleveraging story really kind of blew up in my face. And we talked about how I, had the courage to lean into something that wasn't natural to me and sell a lot of energy at the start of the pandemic. I didn't sell enough of this credit, which at that point, the thesis had been broken. And that was a costly mistake I made. And it taught me that, in cyclical industries, it's particularly challenging to look at the leveraging stories, because that balance sheet improvement can be quickly offset by getting caught in a cyclical down cycle. So your band for stress testing the bear case really has to be wide. And it also taught me that, as my trading partner, John Sargent, says, that the first bid is the best bid, which means your first opportunity to sell when a crisis is developing is probably going to be the best chance you have to exit. So cut your losses early if you can, when the thesis has changed. And I didn't do that. So these are all, very, very hard-earned lessons, but some that I apply to this day.
Yeah, I mean, I love the lesson because it's both fundamental and technical in nature.
That's right.
Mentors. Maybe share one or two mentors, if you will.
Yeah, so I just alluded to, but my trading partner, John Sargent, who, executes on the ideas once we put them on the trading desk, has been integral in my process of understanding markets. He has this keen ability to understand the psychology of markets, and that, he's taught me that markets are really this second order system where it's not about just what you think is going to happen, but really queuing into what does the market think is going to happen and how will prices move as a result of that. So really this second order level thinking is something that I've taken from him. And then kind of cheating, but a combo of portfolio managers, Pramod Atluri, who you had in your podcast before, and Chit Purani. They're both core ag managers with very different styles. And so from Pramod, I've learned to be bold with your ideas. If there's something you like, make it meaningful in the portfolio so it can drive it can drive returns. And he's also taught me to kind of overlay a overall kind of structural view with cyclical views. And this comes from me being a very cyclical investor and, kind of anchoring in a more longer term structural view. And from that home base, then you can kind of tweak portfolio construction to adapt to the cycles. From Chit, I've learned, within this process-oriented nature, that you can create really efficient portfolios. And so you can really seek for best expressions that maximize the level of compensation you get for a given risk that you're underwriting. And, I now kind of obsess over this efficiency of portfolios that I've learned from Chit.
He's a bit of a scientist.
He is, so it appeals to my thinking.
Let's finish up on a personal note. Hobbies. what do you like to do when you have free time? We haven't given you a lot of free time with taking on this broad portfolio management responsibility, but when you have a little bit of time, what do you like to do?
Sure. So, for me, I really enjoy, after what can be hectic markets, going into a more pensive, meditative state. And for me, that's doing floral design and flower arrangement. So being in New York City, you don't have a lot of nature around you. And I find that, bringing in a lot of flowers into my home is one way to keep nature nearby. But more than that, it really taps into a creative side that I don't get to use a ton at work, it being so technical. And the emotional component for me is, growing up in Medellin, Colombia, that's known as the city of flowers. Flowers are such an integral part of that culture. So it's a little bit of my escape, but also it's of sentimental value, if you will.
Well, I'm going to get you in touch with my wife, Chrissy, because she likes to do flower arranging as well.
That.
I'm going to share with you our Be Obsessively Grateful mug.
Okay.
You can keep that. We'll send it to New York. We won't make you travel home with it, but share with us something that you're grateful for. Professional, personal, anything, judgment-free zone, but what are you grateful for?
I think along the theme of what we were talking today about is being, for the courage of seizing opportunities and taking chances, whether those are the ones that I've taken or the ones that others have taken on me. So I'm really grateful for my parents for taking the chance at a new life that, has led me to where I am today, or even my husband for choosing a life with me to grow a family, and, even Capital for having me here with you guys today. It's been a great journey. So I'm very grateful for that.
Well, we're grateful you joined us 8 years ago. You've made a difference here, so thank you. And
I appreciate it. Thank you.
Well, thank you all for joining, and I hope you join us again next time, and have a great day.